we're going to have another round of store closures. Now, of course, the corporate media is making it seem like, oh, this was all planned and things like that. What they were doing is they were going to see how it worked out in 2017. They wanted to see how the holiday season panned out, and it didn't. So Macy's right now is going to be closing another 30 stores. This is confirmed. And back in 2014, Macy's had about 800 stores. They are down 200 stores right now. And we're going to see other retailers say, you know something, we need to close our doors. Remember, the numbers they were giving us prior to the holiday season, where they were saying that retail isn't doing incredible, this is what the brick and mortar stores needed. They needed this boost, and they were saying, oh, look at this, it's 4 point something percent. Well, it wasn't that it grew by 4 something percent. It was that it was a little bit higher than last year. And I think when we calculated it out, it was like maybe 0.4% higher than last year, which means the entire sales structure for the brick and mortar stores is absolutely awful. And it's just a little bit above what happened last year. And last year, 6,800 something stores had to close. Now, if you're 0.4%, 0.5%, 0.9% over that percentage of last year, is that enough to keep all the stores open? Most likely not. Most likely we're going to see a lot of returns. We're going to see the actual numbers. Remember, this number that they're giving us is from the credit card company, and this includes a lot of different things. The actual sales from the stores, the traffic that they had, and their actual profits, that is going to show us what they actually did. And when those numbers started to come out last year in 2017, we realized it was a complete and utter disaster. And stores had to go bankrupt. They had to close down. And when we looked at the percentages of sales going from brick and mortar to online, it didn't match up. Yes, online sales are going to grow as time goes on. More and more people are going to be going online. It gets easier to do. But it's still not the apples to apples transfer of everything going from brick and mortar to online. That's so far apart right now, it's not even close. And what we're seeing is that the entire system is breaking down, and it's accelerating. Of course, nobody wants to admit to this because everyone is out there trying to convince us, and this is the mandate of the Fed, where they'll never admit that the economy is doing poorly. And those people in government are not going to come out and say, hey, listen, you know, we've had a huge amount of problems here. The economy is toast. It's collapsing, because there'll be panic all over the place. They're never, ever going to do it. They're going to keep it going and making it look good until the very end, until the system comes down. And then they'll blame it on something else, because that's what they love to do. They love to blame whatever happens on something else. If things go right, they take credit. If things go wrong, they blame it on something else. We see out in the rental market, well, it looks like things are going south, and this might be signs that things aren't going well. Now, remember, going back to 2008, when people were losing their homes, they were short sales, foreclosures, a lot of these people had to go and rent, and rentals boomed during this period of time, and rents went up. Now we're starting to see rents come back down, and we're starting to see this in many different areas. Seattle is cooling off. New York City, the second most expensive major rental market in the U.S. The median asking rent for one-bedroom apartments fell by 3.7% from a year ago. For two bedrooms, it fell by 5%. And we are starting to see this in other cities like San Francisco, Honolulu, Chicago. They're all coming down. Miami, we see rents are coming down by negative 2.8%. Chicago is 15.6%. San Francisco is 2.9%. We're seeing Miami coming down by 4%, Honolulu by 7.1%. And when we look at this, we could see, maybe something is going on here. And we're starting to see that the push to keep these bubbles up in the real estate market in all these 20 cities that Case-Shiller looks at, these are also starting to have trouble, where they're having a difficult time keeping these bubbles as high as they are right now, especially if the Fed is going to start raising interest rates. It's going to throw a lot of people out of the market who would normally buy a house. Actually, what we're seeing over a period of time, there's a lot of people that have already been out of the market. And this is why mortgage applications really haven't gone anywhere, because most of the investments in real estate are speculators. They're hedge funds, investment companies, foreign buyers, and they're buying, 2, 3, 4 thousands of homes. And eventually what's going to happen is that these speculators are going to disappear, just like they did in 2008. And you're going to have all these homes and all these condos. They're just going to be open. And the same thing is going to happen. And we're heading in that direction. Now, remember, they've been pumping the bubbles up in these 20 cities. The rest of the U.S., the rest of the U.S. real estate market, it is starting to fall apart. Houses aren't hitting the height of where they were in 2008. In many places, those prices are much, much lower. Traffic isn't as abundant as it once was. And people are lowering their prices just to get people to come out and take a look at their homes. And we can see that the retail market, the housing market, as interest rates rise, it's going to have an effect on the student loan market. It's going to have an effect on the auto loan market. And we're going to see a lot of things change. We saw this prior to 2008. The Fed was doing the same exact thing. They were raising interest rates very, very slowly, right? At that time, a lot of people had adjustable rate mortgages. They felt the effect very quickly. And they said, oh my God, I can't afford my mortgage. I'm just leaving the house, as interest rates kept on moving up and up and up. And they tried to lock in, and it got out of control. The same thing is happening right now. Not as many people have the adjustable rate mortgages, but it's going to throw a lot of people out of the auto loan industry. It's going to throw a lot of people out of the housing loan industry where they can't get these loans. It'll be very, very difficult because as interest rates move up, you need to make a certain amount of money to afford the house. Because when interest rates are low, you don't have to make as much money to afford the house that you want. So we're going to see things change rapidly. Now, the central banks, they are trapped. And this is coming from Charles Hugh Smith. He wrote an article, Why the Financial System Will Break. You can't normalize markets and depend on extreme monetary stimulus. He said, in a nutshell, central banks are promising to normalize their monetary policy extremes in 2018. But there's a problem with all this. You can't normalize markets that are now entirely dependent on extremes of monetary stimulus. You can't fix an economy where the entire economy is built on an illusion. The recovery was built on an illusion. So remember, back in 2008, in response to the global financial crisis, the central banks, they lowered their interest rates to near zero. In some places, negative. They boost private sector lending, increased liquidity to enable private sector lenders and borrowers to refinance existing debt and generate new credit. They also bought assets, government bonds, corporate bonds, and in some cases stocks via ETFs. The goal here was to prop up the collateral underpinning of all the debt. If liquidity dried up, consumers and enterprises would default, handing lenders catastrophic losses. As the crisis had crushed the market value of the collateral, the lenders would have to sell to recoup their losses. And so central banks pursued an unprecedented policy aimed at goosing private sector lending and borrowing while boosting the markets for stocks, bonds, and real estate. The collateral that supported all the debt was at risk of default. All this low-cost, easy available credit, coupled with central banks' public messages that they would do whatever it takes to restore the credit mechanisms and reflate the private sector markets for stocks, bonds, and real estate, worked. Credit expanded, markets recovered, and then they all soared to new highs. But by lowering the interest rates and bond yield near to zero, central banks deprived institutional owners who rely on stable, high-yielding, safe investment income, insurers, pension funds, individual retirement accounts, and so on, of exactly what they need: safe, stable, high-yield returns. In this whatever it takes type of model, the only way to earn a high return is to buy risk assets, assets such as stocks and junk bonds. And you can see many individuals gone into the stock market, gone into the bond market. The problem is central banks are now trapped. If they raise rates to provide low risk, high yield returns to institutional owners, they will stifle the recovery, and the asset bubbles that are dependent on unlimited liquidity and super low interest rates will pop. But if they keep yields low, the only way institutional investors can earn the gains they need to survive is to pile into risk assets and hope the current bubbles will lift higher. This traps the central banks in a strategy of pushing risk assets already at nosebleed valuations even higher, as any decline would crush the value of the collateral underpinning the titanic mountain of debt the system has created in the past 8 years, and hand institutional owners losses rather than gains. So, can the central banks raise rates without popping the bubbles? Can they do this and keep the system solvent? Well, I doubt it. We've seen in the past when they raised the rates, it didn't work. Everything fell apart. Why? Because most of it was built on an illusion. The subprime security, built on an illusion. It was fake information. They weren't AAA. People believed they were because we were told they were. The same thing today. What the information they're giving us, the unemployment, the GDP, the stock market, it's all fake information. All of this is going to come down. And I think the reason they're raising the rates is so they can bring them back down again. Think about what they did prior to 2008. The rates were low. They started to bring them up. And they reached a point where everything started to fall apart. When everything started to fall apart, they started to lower the rates again. And they kept lowering them. It didn't help because they already ignited the fuse and it was burning and people were getting out of the way. People were abandoning their houses and businesses were coming down. But they kept lowering the rates because they didn't care what happened in the economy as long as they can bring the rates to where they needed to go because they knew they needed to do this. I think the same thing's happening. I think they're bringing the rates up as far as they can get them so they can say when everything starts to fall apart, they could say, hey, we need to bring the rates low. And I think they're going to go negative at this point. And we can see that this is all in preparation for the collapse. Now, we know that everything is moving away from the West and moving to the East. We see that China and Russia, they've been preparing. And remember, this is the central bank just moving their base of operation to someplace else to restart their system because their old system is crashing. Of course, they're going to blame this on something else. They don't want people to know that their old system is crashing. They'll say it crashed because of maybe Bitcoin, because of some type of distraction, maybe war, or some type of an event. But whatever they do, they're not going to take the blame for this. And we're starting to see that there's going to be a push to take control of the cryptocurrency market. And I think the central bankers are making this push right now where they're trying to take control and force everyone into what they want them to use. Just like back in 1913, they wanted everyone into their currency that they wanted to create. Today, they want the same thing. And the only way to do this is to create laws to force people into it. Because you can't just tell them, the central bank just can't come out and say, hey, you need to use our Fed coin or our utility coin. No, they need governments around the world to tell their people to do this. And the only way to do this is to scare them. This is their tactic they use. Crash the economy, crash Bitcoin, crash the crypto system, and say, see what happens? It's very volatile. It's very dangerous without the central banks managing it. And I think this is the move they're going to make. Now, is this going to work? I'm not saying it's going to work, but this is the tactic they use. We see already out in China, the PBOC call for rectifying irregularities in electricity use of some Bitcoin mining fields. And what they're doing is they're going to limit the amount of power the miners can use. Now, think about it. The entire operation of mining Bitcoin and other coins, they're in these huge server rooms where the servers are working and it uses a certain number of uses electricity to generate and to operate these servers. If countries, even here in the United States, put a regulation in place where they limit the amount of electricity you can use, well, guess what? They're able to stop the production of Bitcoin, Dash, Litecoin, anything. And you can see that what they're trying to do is they're trying to figure out ways to regulate. And that's the key word, regulate. They want regulations to control what is happening right now. And we can see that they might even tax. And again, this is the central banks looking to take control of the currency system. I'm not saying this is exactly what's going to happen or they'll succeed in what they're trying to do, but they're going to give it their all to try to do this. Hopefully, the people say, no, we don't want this. We don't want the central banks getting their fingers into this. But again, it all depends on those people in government. Those people in government, when the central bank was trying to get into the system, they were paid off. And they allowed the central banks to get into our system. And we've had it since 1913. Yes, we've had other central banks, but Andrew Jackson removed the last one. And hopefully this time around, they don't have the ability to get the government people to pass these laws. The people are going to have to speak up and say, no, we don't want this to happen. We don't need these laws. And hopefully other countries do this. So what we're seeing right now is they're getting everything prepared for the system to come down. They want control of the cryptocurrency. They want their system moved from the west to the east. They want everything in place. And it looks like they're almost there. We're heading to this time period of where they're going to have no choice but to eventually bring it down. Because if they don't bring it down, it's going to come down on its own and they won't be able to control it. And they don't like losing control. They like having full control of when these things happen. And it looks like they've been trying to keep this afloat for this period of time until they can figure out a way to distract everyone away from the real reason of why the economy is coming down. And that's because it's their system. Their system always comes down. After a certain